All right, everybody. Welcome back to Strongman Personal Finance. Today, I'm going to talk about how your 401k can get you a nice, swole retirement. Let's go. If you work for a corporation, you probably have a 401k plan that you can invest in. The term 401k comes from the U.S. Code. It isn't just some made-up number that somebody pulled out of their butt. It actually refers to a subsection of the U.S. Code that specifies how employees and employers can invest in these plans. One of the greatest benefits is that you can invest with pre-tax dollars. For example, if you make $4,000 a month and you contribute $500 to your 401k, that means that only $3,500 of your income is actually taxed. That $500 that you contributed is not taxed at the time that you put it inside your 401k. So on the upside, you're not paying taxes on the front end. But what's going to happen is once you enter retirement, once you withdraw that money from your 401k, that money is going to be added to your ordinary income. So you don't pay taxes on the front end, but on the back end, when you take the money out, that's when you're going to have to pay taxes. And if you think about it, it makes sense. Big Daddy government is not just going to give you a completely tax-free tax benefit. They're going to want their money back eventually. One of the other great benefits is that money grows tax deferred. What that means is you don't have to pay any kind of capital gains tax if you sell any mutual funds. You don't have to pay any kind of taxes on dividend distributions. You don't pay taxes while the money's in the account. You invest it tax deferred and it grows tax deferred. And then when you withdraw it, that's when you pay taxes on it. Another great benefit is that your employer probably provides some kind of matching contribution. For example, your employer might match dollar for dollar every dollar you put in this plan up to, say, 5% or something like that, which is basically free money. You put in 5% of your salary, your employer matches that, boom, you just invested 10% of your salary. You can invest up to $19,500 a year in a 401k. And if you're over 50, you can actually invest an additional $6,500. That's called a catch-up contribution. So basically, if you screwed off most of your young life and didn't save any money, the government gives you the opportunity to put more money in your 401k. The downside is if in your 50s and you're close to retirement, that extra money is really not going to grow that much. But that's another story. Now, once you invest your money inside a 401k, the 401k itself is not an investment. What happens is you fund your 401k, and then within that account, you purchase investments. So the 401k itself is not some kind of mutual fund. There's mutual funds that you can buy inside a 401k, and mutual funds that you can buy outside your 401k. But you need to understand that the 401k itself is not an investment. It's just a tax-advantaged investment account. There are some downsides. The first one, you can't withdraw that money penalty-free until you're 59 and a half. If you do, you're going to have to pay taxes on that withdrawal, and you're going to have to pay an additional 10% penalty. For example, if you're in the 22% tax bracket and you withdraw from your 401k before you're 59 and a half, you pay 22% tax on that withdrawal, and on top of that, you pay an additional 10% penalty. What the government is doing is they're trying to make you keep that money in that account so that it's actually there for your retirement. So they try to discourage you from withdrawing from your account by adding that 10% penalty. Now, if you really need the money, you can take a loan against your 401k. Not recommended because that money's for retirement, but you can take a loan against it. You can take out up to $50,000 or half of your balance, whichever is less. Once you take out that loan, you're gonna have to pay about 5% interest based on current rates, and you're gonna have to pay that back over 5 years maximum. There's a couple other ways you can get your money out of the 401k without paying the 10% penalty. You'll still have to pay the taxes, but you can avoid the penalty. Some of these reasons include buying a new primary residence, not a vacation home, tuition for college, if you have certain types of medical debts or medical bills, and with the coronavirus, there was a new legislative law that was passed that said you can take up to $100,000 out, and you can actually pay the taxes for that withdrawal over the next couple of years. So there are a couple ways to get the money out penalty-free, but they're mostly for hardship reasons. You can't just take out money from your 401k willy-nilly. If you want to know for certain, go talk to your plan administrator. Your company should have a 401k plan administrator. Maybe go talk to Human Resources office and they can point you in the right direction. But they can help explain to you exactly what reasons you can use to withdraw that money before you're 59 and a half. Once you reach age 59 and a half, then you can start withdrawing the money penalty free, because that's when you're supposedly going to start retiring, all right? And the government wants to start collecting tax revenue, because when you take the money out, now you have to pay taxes. Whatever money comes out gets added onto your income, and that goes into your total tax calculation for the year, all right? 59 and a half is when that starts. However, you don't have to take the money out until you're 72 years old. When you turn 72, that's when required minimum distributions are triggered. Required minimum distributions, also known as RMDs, are calculated based on your life expectancy. Once you turn 72, the government has a rough estimate of when you're going to die. So they're going to look at a chart and they're going to say, okay, since you have this many years left to live, you're going to have to take out X amount of money from your portfolio. And that's just because the government wants their sweet, delicious tax revenue from you. That's why you have to take RMDs, okay? Now for a quick review, the 401k is a tax-advantaged account that is offered by employers to employees. This account allows employees to invest pre-tax dollars and allow those to grow tax deferred. Now, the growth of those investments are based on investments that you pick inside the 401k. The 401k itself is not an investment. It's simply a holding account that gives you certain tax advantages, all right? A lot of people confuse that. On top of that, you can invest up to $19,500 a year into this, and your employer is allowed to match some of your contributions. That gives you free money. Now, because the government wants to incentivize you to keep this money in the account, they're going to penalize you for withdrawing money. You can take money out as a loan, which you'll have to pay interest against, or you could take it out for a hardship withdrawal. But basically, the government does not want you taking out the money, and they're going to try to shape your behavior, and they're going to do so by charging a penalty on any withdrawals before 59 and a half. Once you reach 59 and a half, then you can start taking the money out of the 401k. When you take the money out, you're not going to pay that 10% penalty, but that money is going to be added to your taxable income. It can even put you in the next tax bracket. If you keep your money within the 401k, you're eventually going to be required to take it out with a required minimum distribution at age 72. Once you start doing that, you're forced to take it out, and the government starts collecting taxes on your investment. Now, if you're freaking out because I haven't mentioned the Roth 401k, don't worry. I'm going to make another video about that one. This one is specifically about the traditional 401k in which you invest pre-tax dollars. Now, there's a ton of benefits to investing in your 401k. First and foremost, your employer will probably match some of your contributions, which is basically free money. When you invest and your employer matches your contribution, you're automatically getting 100% return on those matched dollars. And you didn't have to do anything, all right? That's a great benefit. Another benefit is that the money grows tax deferred. So every year, if you have to rebalance your portfolio, or if there are any dividend distributions on your investments, you're not having to pay taxes. That helps you actually increase your returns over time. I also personally like how the government penalizes you for taking money out of the account. It's a good thing because that money is specifically supposed to be used for your retirement. You don't want to be dipping into your 401k to buy willy-nilly BS. That money is there to grow, to fund your retirement, so you don't become a burden to the taxpayers. I love that 10% penalty, and I hope it never goes away. And now, let's talk about the downsides of the 401k. The biggest one is going to be the fees you're going to have to pay. Now, I looked this up on the internet, which you can always trust, by the way, and I saw that the average fee that an American pays is 2.22% of their investment every year in management fees for their 401k. That's pretty freaking high. Most of my investments, I pay about 0.15%, which is way cheaper than 2.22%. With that that means the average American is going to pay about $150,000 in management fees. That's pretty significant. That's one of the downsides. The second downside is that your employer might not give you many options for investments within the 401k. A lot of the times, your employer will have some kind of contract or agreement with an investment company, and that company will provide a certain amount of options for you to invest in your 401k. Now, it may be a good management company, but a lot of them can be pretty crappy, and you don't have much choice to choose the investments that you want. So that's a big limiting factor of a 401k. Another downside is that a lot of the times employers don't really educate their employees. Basically, the employee joins the company, they go through in processing, the employer says, all right, here's your 401k, what do you want to invest in? Gives a pretty crap explanation, and then the employee just kind of has to guess on what to invest in. That's a pretty huge disadvantage. Now, to sum this whole video up, I think you should invest in your 401k even if it has high fees. The reason I say that is if your employer gives you a matching contribution, that return, that guaranteed 100% return right off the bat, is going to beat those fees. Now, if the fees are extremely high and the mutual funds inside the 401k suck, what you can do is invest your money up to the match in your 401k. Then invest any additional money to max out your IRA. Once you've maxed out your IRA, then you can switch back and put the remaining money that you have available to invest back in your 401k. Yeah, the fees might be high, but the tax advantages of these investments, of these investment accounts, are pretty significant, okay? Invest in your 401k, and for the love of God, do not take a loan or cash out your 401k for something stupid like a wedding or a vacation. All right, everybody. Hope you enjoyed this video. If you liked it, smash the like button, subscribe to my channel, and hit the bell button for notifications. You guys have a wonderful, delicious day.